Hi, everyone, and welcome to this week's installment of StockCharts TV. I am your host, Mish Schneider. And this week, we're going to do something more evergreen. It's really going to be a very brief overview on some of my favorite stock patterns, chart patterns that you can use to help you trade. As you know, week after week, I give you very actionable information. But for this week now, you'll be able to put this away, watch it over and over again as I review flags, for example, bear and bull flags, and gaps and consolidation patterns, head and shoulders, wedges, cup and handles, and reversal patterns. So I hope you enjoy and get a lot of great knowledge out of this.
So we're going to start with the bull flag because it's really a great way to see something that's moving up in terms of a continuation pattern. So it basically what you want to see is that you want to see a pole, as you can see right here, what they call a flag pole. So it would be some kind of price action that you can bring it down, whether it's in pure price or whether it goes to some support level here. And then after that, literally you get a wedge where the price pattern stays within these parallel lines that descend, obviously in a bull flag. And then once you get the breakout out of that bull flag, the price should continue on up. The thing that is really, I think, the most important thing to understand about bull flags in particular is that you want to say that the measurement of the actual pole, so if this goes from 160, say up to 195, so $35, generally is what it brings to you in terms of actual price movement once it breaks the flag. So you can see here, that would be from 180 to 215, and it almost went there absolutely perfectly. So that's something that you really should get yourself familiar with, particularly on these great up moves when they take some kind of a pause or they correct for a few days and then break out again. Now, on conversely from that, you have a bear flag. Now, I like bear flags on daily charts. I happen to really love them on weekly charts because then you get tremendous amount of information. And I've seen lots of moves way lower on the weekly charts. And also you get a very accurate measurement. So here in this case, you can see once again where there's the flagpole going down, only this time you have the parallel lines pointing up. So just the reverse, it's a move down that then bounces, whether it's for short covering or what have you. And the difference between it being, let's say, a reversal pattern where now it's bottomed and gone back up is that it never breaks out of the first parallel on the top and then eventually breaks down on the parallel on the bottom, which of course your stop would generally be above the flagpole, let's say if you were short, and below the flagpole if you were going long. So now let's also take a look. So this goes from 44 to approximately 41. That's a $3 move. When it breaks down initially, we want to look for a move down to about 39. It actually goes much lower, but you can see if that was a first goal in terms of a target, you got there pretty well. Now, the next type of formation that I really like, and you've heard me talk about this week after week after week, are gaps. And there are all different types of gaps. So we're going to briefly cover each kind. The first one is when we either have a continuation gap or a reversal gap, and they are called either a breakaway gap if it's a continuation or an exhaustion gap at the end of a trend. And certainly if you take a look in the market through the last year, and particularly over even in the last several weeks as we're into the end of 2021, we've seen a lot of these breakaway gaps and we've seen a lot of these exhaustion gaps. So a breakaway gap will start a new trend. And so let's say we have a period of consolidation, what another chart pattern we'll cover later, on good volume. On the day it gaps, that's what you really want to see. You want to see it hold the gap, and you want to see the gap hold for several days, and you want to see some volume. On the flip side, an exhaustion gap is when the market is going down or corrected, or the particular instrument, it gaps lower on very high volume, and then the next day it gaps higher again, leaving literally an exhaustion signal that the move down is over. So a runaway gap is another type of gap, different than the breakaway gap, because it basically means that these gaps occur as they're going up in a straight line. So you get a gap up and then another gap up and another gap up. That's really showing that that particular instrument is not only running away, it's actually going parabolic. And so that again would be accompanied by very high volume. An island gap, this is actually one of my favorites, can be either at the top or bottom of a trend. And literally, like an island, it leaves a gap and then gaps up or down the next day. And that price movement of the island actually sits like an island in that there's no price around it. We're going to take a look at all of these by example. So let's first of all talk about a breakaway gap. So this is what I was mentioning to you before. You get a period of great consolidation, and then boom, you get the breakaway gap up and it gets followed through the next day. Now, of course, you can see that this actually wound up going back down, but nonetheless, this breakaway gap was a good short-term signal that Amazon went from 2,000 up to 2,200 or close, not a bad move up. So again, this means that the continuation pattern is happening, but it doesn't necessarily mean that it continues forever. Always have to use good risk parameters and good profit-taking parameters. Now, a reversal gap, these are the ones that I like. You've heard me talk about mean reversion. Often they're accompanied by that. So you can see that we had a breakaway gap down first. And then after it had, interestingly enough, we'll talk about this in a little while, 2 inside days, it had its reversal gap up and never saw the light of day again down there. And that was really, to me, the bottom of this, not only particular instrument, but it's a bottom that I look for constantly. Now on runaway gaps, essentially, it clears everything as it did here. And then look at how nicely that moved up. So you had a gap here, then another gap here. Not quite, it's opened up with a gap here that day. You can see based on the candle, this was the open, it filled the gap. And then we could talk about what this is, but this is actually a pretty interesting reversal top pattern which followed through to the downside. The point is that with the runaway gaps, you never want them to get filled. The volume should be good and they should last for several days. Now, a gap island bottom is so rare to see. And regardless of whether I think about the particular instrument or the market condition, it's a very high percentage win trade. So it's one that I will do even if I'm worried that I might lose money because of the fact that it's so rare. So in this case, you see, this is actually in copper. So here, what do we mean by an island bottom? It gaps lower, then it gaps up the next day, and it never fills this area right here, leaving an actual island all by itself. Now, the next one we're going to talk about now is we're going to leave gaps and we're going to talk about consolidation or compression. Also, extremely important way to identify when something is about to break from the consolidation or the compression, whether it's up or down. So literally, again, you get a horizontal movement this way. And let's get a little pen here so we can actually draw here. So price action would be going relatively horizontal on both the top and the bottom for a certain period of time. The longer the period of time, the better, the more powerful it's going to be once the price breaks from this region. Some people would also call it a rectangle formation. So I didn't exactly draw these perfectly parallel, but they can be parallel or they can be slightly off. It doesn't matter. It doesn't have to be absolutely perfect. The thing is that you should have a support level and a resistance level that it's been following for a long time and then eventually breaks out of. And just to see what it looks like in different types of charts, actually, we're looking at XLU here, which is the utility ETF. So you had a period of months here, starting in July, August, and September, and actually towards the end of August, we broke out of this sideways consolidation and we had a nice follow through to the downside. Then here you're seeing it just the opposite. You had a period of sideways consolidation between 36 and 39, and then boom, it breaks out to the upside. Now, sometimes when you're looking at the chart down here, the sideways consolidation could be pretty wide. So what this box doesn't complete is the resistance here at 44 and the support at 41. And look how many months that went on before it took it out. And then here you can see it's really showing you the support level here at all these levels here. If I would have drawn the parallel to the top, it would be here. And again, it broke out and had a tremendous amount of consolidation. And this is something that we see over and over and over again in markets. And so what you try not to do is trade within the chop while it's consolidating, but sit very patiently and wait for that high volume breakout. Now, the next one, and again, you hear me talk about this very often when I do my weekly videos, inside days. Inside days are also called Harami patterns. They are really a great signal that there's been a stall, a pause in the action, and traders aren't really sure what to do. So essentially what it is you can have an inside day. By the way, you can have an inside week. You can have an inside month. They're very powerful, obviously, the longer the period, but essentially you have your trading range on one day, and then the next day you have a range within the range of the day before. It's interesting in this particular example is what you also have is a doji day that day, which means the opening price and the closing price are very close together. That's about as hesitant and as paused as one can imagine traders to be on this particular time. So what you want to do on an inside day, particularly if it's in the direction of the trend, or if it's going to be a trend reversal, that's more information. But if it's in the direction of the trend, which clearly you can see the trend in this one is up, is when it takes out the bar of the outside day or the price of the outside day is when you know now that there's more commitment from traders and we should get the move up. Same thing could happen, by the way, on the downside. Now, let's talk a lot about wedges here, because wedges are another really good way to anticipate whether something is either going to reverse trends or continue with a trend. And so essentially, if you draw trend lines on your chart, where we just showed you parallels with flags and parallels with consolidation, with wedges, you actually eventually see the two lines form to converge at an apex. And again, the longer the wedge goes on, the more powerful the move is going to be when it breaks either out to the upside of the wedge or down to the downside of the wedge. And of course, the other thing is that you want it to be close to the apex, but if it goes right down to the apex, often that's like a dud firecracker. So this is a really good example. And so if we have a bullish wedge, you're going to see the top slope this way, sort of kind of higher highs, but you're also going to see higher lows, like I said, until they reach some kind of apex. So what you're looking for is the breakdown. And the same thing with the falling wedge. You're going to see lower highs and lower lows, and then eventually it breaks out of that wedge here. You have to be able to connect at least 3 points. In this case, you see 4 points. So if we look at actual example here, this is fifth serve. This is not really greatly drawn here. It really should be more like this. And I apologize for that. But nonetheless, you can see that we had a series of higher highs and a series of higher lows. We were able to draw this line. Eventually, it would have gotten to the apex, and it was the end of that move up once it broke down underneath that wedge bottom. And here is a falling wedge. Now, in this case, this was happening on a correction. You could also have said that it's possible that it happened here when it went like this. And I'm not drawing these like I did before to scale, but it went something like this and something like this, and then it broke out. But let's look at this one here, because now after its breakout, it had a tremendous amount of chop. It had lower highs and lower lows, and then boom, it broke out to the upside and continued the trend up. So very often, not only consolidation and flags, but all of these ways are great if you miss a move and you want to get in, but you want to wait for some chart pattern so that you can not only understand it's ready to continue or reverse, but that your risk to the bottom of these wedges is really not only a good risk, it's the best risk to have in terms of risk reward. So let's talk a little bit about head and shoulders. I see people use the expression head and shoulders all the time. And looking at head and shoulders, it's another one that could be somewhat lopsided or perfect, depending on how you're seeing it. Looking at a perfect head and shoulders, of course, is relatively rare. So in this case now, of course, we're seeing these drawn perfectly, but essentially you have a shoulder, a head, and another shoulder. And then you can see at the two shoulder bottoms, that becomes your neckline. This is what a head and shoulders top would look like. And obviously, if the neckline breaks, then they're saying that that's the end of the move. If you go back and look, though, I can't tell you how many times people ask me, is that a head and shoulders top? Is that a head and shoulders bottom? And very often they're fake outs. So it's a good thing to have on your radar, but you really have to be aware of the fact that sometimes they don't work perfectly. So you want to have as much symmetry as possible. In other words, you want the left shoulder and the right shoulder to look not only relatively similar, but the points of support to be close to each other, and the points of resistance where the neckline is to be relatively close to one another. And then, of course, the head to be lower. And all the distance in between to be somewhat symmetrical is the best. That's why there's a lot of fake ones. And again, on this case, it's an inverse head and shoulders, inverse meaning that once it breaks out of the neckline to the upside, then you're going to get the move up. So let's take a look at a couple examples. Now, this is a head and shoulders top. Here's your left shoulder, your head, your right shoulder. So now that we're seeing it in real time, you could see it's not necessarily perfect, but if you start the shoulder here, it becomes a little bit more perfect and end it here in terms of the symmetry between this shoulder. You can see again here you have support levels here, and then they both shoulders stop somewhat here. It's very hard to determine it because it's not going to be as perfect as what I just showed you on a textbook drawing. But nonetheless, you can kind of get the feel for it. And the most important thing here, of course, is that when it finally breaks down from the shoulder, as it does here, you get good follow through. And your risk should probably be not that great because you can get a fake out easily, as it looked like it was going to happen here on. And you might have even gotten stopped here, but you might have gone back in, let's say, if once this broke down onto 64. So that's why I like these head and shoulders to point out. And I've seen textbook ones, but they're not so easy. This is much more textbook. So this is McDonald's illustration right here. And you can see it's already drawn for you that you had your left shoulder, your head, your right shoulder. Look how perfectly symmetrical this one is. The distance between the left shoulder and the right shoulder are almost exactly the same. In terms of the support levels, they're not perfect here, but you do have 1, 2, 3 points touching around that level. But in terms of the neckline, you do have, again, not perfect, but close in terms of where they all hit as resistance points until the day we had, guess what? A gap higher. So a head and shoulders coupled with a gap, followed by an inside day and another gap. That's when you start to really become an expert in some of these chart patterns. And even if you miss the initial move, let's say you miss it with the head and shoulders breakout, but you catch it on the gap, or you miss the gap and you see the inside day and you get it on the next gap, as long as you can find your way into a good reward versus risk, then it's still a very valid trade depending on your time frame. This is another one that you hear people say over and over and over again, a cup and handle. So I'm going to read to you the definition of this. A cup and handle strategy is a trading strategy that is based on a familiar pattern in TA, which looks like a cup followed by a handle. So if you just picture yourself holding a little teacup, as you see here, the price action is such where it forms a round base forming the cup. And then it almost looks like a flag here, but here's your little handle right here. So it breaks out of the cup, it goes down and creates some kind of a trend line with 2 or 3 points. Same thing with the top, parallel, 2 or 3 points, breaks out of the cup. And very often, same thing, they feel that the level of price movement is going to be the size of the cup. So if it goes, the cup goes from here to here in terms of the breakout, or even to here before the actual handle is formed, that's going to be somewhat of your measured move. So let's take a look at a couple there. So here's Biogen. This is drawn here, but I would actually draw my cup more from here. Here's your cup. nice rounded bottom, now broke out of the cup. You had several points that you can connect here. Again, it's never going to be as perfect as it looks like in a textbook. I would say your top formation should have been right here. Things get moved when I make these PowerPoints. But now in this case, you had a nice little breakout and you had a tremendous amount of follow through. In fact, if you look at this, let's say at around 240 to where it broke up out at about 280, $40. Then from 280, it went to 320, almost perfectly, went a little bit beyond that. Now here's a cup and handle top, so you can have it both ways. You don't hear too many people talking about cup and handle tops, interestingly enough, but here's a good one. So again, you got a rounded top. Now you could almost say this is kind of some sort of a weak head and shoulders top, but it's better to say a cup top because you had the rounded top, rallied a little bit, could have also been considered a bear flag. You had your points of connection here, your points of connection here. It broke down and then whammo. Now, in this case, you went from $24 to $34. So $10 means a move down to 14. I haven't seen the rest of this, but you got down to about 16 here. All right, another one. You're going to hear me talk about brick wall bottoms and glass bottoms and brick wall tops and glass ceilings. Often I look at it by the eyes of actual mean reversion trades as well. Those of you who have the plugins of ours from Market Gauge on your stock charts know that you look at mean reversions using Bollinger Bands on price and Bollinger Bands on the real motion, and you use your 2 standard deviations. So sometimes that's a nice confirmation for something that actually could be putting in a good reversal pattern. You have your basic 60+ day new high and low, and we're going to look at that. But then you have things that we define as brick and glass. Now, in terms of the brick wall bottom, now again, you can see that you had your move lower, and look at this, a new 60-day low, and the next day it actually was a 60+ day low reversal pattern as far as I can see, because it took out the top here and closed above this bar that it made a new low. That's your confirmation that it looks good. But the next day, look at that. You had an inside day. The next day after that, it didn't really go anywhere. And so essentially what this was telling you is that you needed another move back over here, and we don't have the information to see if that happened. In order for this to confirm that this 60+ day low, and by the way, you keep your risk underneath the low of that day, actually turned out to be a reversal. But you can see that there are other times where you had a new 60+ day low, inside day, gap up, and then boom, big move up. So these are also another way to look at it. And these new 60-day lows often are formed several times in certain instruments. In this case, it wouldn't be a new 60+ day low, but certainly was here. If we take a look at a brick wall top, it's going to be just the opposite. So you're going to get a new 60+ day high. And then the next day, you're going to see it break down underneath the low of this day. It should never get back over here. And then boom, you can see that in this 2-day pattern here, you then get your big move lower. And by the way, this here was a new 60+ day low. So was this. So that's why you have to be sometimes somewhat cautioned. But in this case, after a big move, probably lower relative strength at this point, maybe oversold. You also had a gap, and then again, a nice move up. So these chart patterns are great for really major trend changes. They're also really good for those who like to trade more actively. Now, a glass bottom is my favorite. Brick walls are a little harder to discern because sometimes they're not as clean, but a glass bottom is a very clean pattern of a new 60+ day low, reversal of some sort that day. And here's the key, you don't see it here, is on very high volume. And then the next day, you get the follow through and the close over the high of this day. This very often means end of trend down, on to trend up. These are some of my favorite swing position trades. And then a glass ceiling, just the opposite. Also a 1-day pattern that confirms the second day, new 60+ day high, generally on a lot of volume. So it's almost like the last of the bulls or last of the bears are in. And then you get the confirmation the next day where it breaks down under that low. And again, you would have your stop over this high and be patient to see if that actually turns out to be the case. So I just want to show you a series of 60+ day reversals, highs and lows. So you can see here, here's one series where you had a new 60+ day high, and then boom, you had the brick wall top, and that was good for a move down from, let's say, 132 down to 126. Here it happened again. You had a new 60+ day high reversal pattern. This was a good one day, and you had a move down. And if you would have gotten out, again, based on your timing parameter, in this case, you also have to understand the phases. I mean, like I said, these are chart patterns, not that you live and die on the sort of any one chart pattern. But in this case, you would have at least known that when it got through the 50, that wasn't really a good top for any sustained move lower. You would have gotten back in, but then here you got another one. And then another one-day reversal that actually really did yield a lot of good money until it took out the 200 and the next day came back through it. So you can see, and by the way, I've done another evergreen on phases that you should look up if you want to check out these evergreen moves. I've also done an evergreen one on opening ranges and how to use them in order to time your way into these patterns that I'm looking at with you today.
So as I said in the beginning, this was a very brief cover of some of these chart patterns. And obviously there's a lot to learn, but if you can get a general idea of what these 8 patterns are, it should really help you go forward in your year of trading in 2022. Thanks so much, and bye for now.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.